Welcome to the Dividend Talk Podcast, episode 213. Sectors benefiting from interest rate cuts. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. How's your week been?
It was one of those weeks, very busy. I was abroad, so you know how it goes. Full day of work, very intensive from the early morning till the, let's say, the early evening. Dinners after that, coming almost at midnight to bed, let's say. So I've had a shortage of sleep. Was not on social media at all. Not really followed the stock market this week. It was really one of those weeks. How about you?
I don't know if you get the same, but my family, especially my kids, think that traveling for work is a holiday, that it's easy.
Oh, no, not at all. It is overrated.
It is completely overrated. I mean, you have to go to work, you're up early, you're probably doing long hours, and then when you're finished, you normally go for dinner with the people you're working with,
Yeah.
and you speak about work.
Exactly.
It's long days, but I don't look forward to them, honestly. But I haven't.
And the flights are never at a convenient time,
No,
either at
no.
6 in the morning or late in the evening.
Yeah, or we're always down. We fly to Italy quite a bit, but it's always connecting flights, and we're always hanging
Oh,
around, and it's a disaster. But hey, look, could be worse. It could
yeah.
could be a
One
lot
day
worse.
the dividends will cover all these worries.
Well, yes, exactly. Or I'll just get a job that doesn't need to travel.
Well,
Hoping-
maybe the Dividend Talk newsletter.
Yeah, exactly. Let's jump into the news of the week, because there's one that was brought up on Facebook. I'm sure you've read about it or heard about it, but it's your good old company, Tupperware. And they are filing for bankruptcy. I've seen some articles today that obviously the banks and the lenders are not too happy and are pushing back on this. But at the moment, they just can't cover their debts. They said that their efforts to modernize and transform into a digital first company has not really worked. I mean, how do you turn plastic containers into a digital first company? I don't know. But look, they've got assets between 500 million and 1 billion, and liabilities between 1 billion and 10 billion. So they're quite struggling. One thing to note, though, is they do plan on operating through bankruptcy and still paying their employees and stuff. But what do you feel about this? Is it quite sad? Is it nostalgic?
I don't really have a feeling to it because I sold on time. I'm just checking. I bought them at an average price of €50, and I sold $50, and I sold them at $29.
Oh.
So I always thought it was a little bit different, but I'm now checking the real numbers here in front of me. So yeah, I made some loss, but not a crazy loss. So 21 out of 50, 42%. So it's not entirely crazy. I still got quite some money out of it. And also I'm looking at the position size. I mean, in today's value, wouldn't have been even 1% of my portfolio.
Yeah.
So at least from a diversification point, it must have been 3% of my portfolio at the time, but it's now like 1% of my portfolio. So honestly, I mean, this company. That's why they are bringing it up, because I felt like Germans love Tupperware parties, and then they had this CEO was mentioning, we are going to Indonesia, empowering women, and they will all do Tupperware parties, and to put their Indonesian food in there, whatever. But I think, the Germans killed the company, right? By not having Tupperware parties anymore. It's really simple. This new generation, these millennials in Germany are killing us. They want to tax the rich. They don't want, they think cars are dirty, and they stop doing Tupperware parties. I mean, nothing good comes out of it. At least not for capitalistic people.
No, and those who enjoy Tupperware parties as well. But I don't think. Look, you spoke about this company quite a few times. I don't think this comes as a surprise at this moment in time.
No, I mean, I totally thought that the emerging markets will be their growth factor, and oh boy, what have I been wrong?
Yeah. It's just plat the containers.
I have the containers in my basement here, right? You get them as a present from others that were probably doing those Tupperware for a wedding even, and they've been collecting dust here for many years. I mean,
they might be worth money in a few years when the company's out of business and they're scarce. They might jump in value.
Yeah, but I mean, I don't think there are really many people still, at least in the environment where I work, that are still putting sandwiches in a box and taking them to work. Yeah, most people buy their lunch at work in the sector that I work, and this was not the same 15, 20 years ago.
Yeah.
Maybe that's also a reason. I don't know, but I guess I could say this is the first company that actually is filing for bankruptcy in my whole journey that I ever owned. I mean, General Electric that we spoke about next week didn't declare bankruptcy, and they seem to have their mojo back. But this is the first one. Yeah. So I've got one. Can you say this, by the way?
I've gone bankrupt? No, not at the moment.
No. So you need to still get that one before you may really say you're a seasoned investor.
Do you know what? Walgreens is well on its way. Nike have some interesting news this week, and they have changed their CEO. We got a couple of questions on this from Source and El Cuba. Did you see this coming? Was it?
Well, there was a large voice, at least on social media, all the time that the CEO should be replaced, that he killed the company, that he doesn't have a feeling for it, that he's milking out the brands and not really innovating. And that's what you see sometimes, right? That companies, for instance, start lowering capex, but sales are up. We saw this with Intel as well. They're just squeezing the last drop out of the lemon, which in itself we always want, but not at the cost of innovation or something like that, because then you're just boosting up EPS. And I think this has been happening here. Also, there's a lot of criticism now on the direct-to-consumer business model. But come on, let's not be a fool, right? I remember in 2021, all the articles on Seeking Alpha, what a masterstroke this was to do direct-to-consumer. It was everyone's bull case for long-term growth. And now a lot of the writers are like, this was stupid and this and this. So it shows you also a little bit like... I mean, I don't expect people to be consistent. You can change your mind. I think this is important as an investor. But what I rather see is that people maybe just paraphrasing management, what they are saying, and not thinking too much for themselves.
Yes. I mean, look, hindsight is obviously 2020, but it's easy to get caught up in the vision because they present it so well and give you growth numbers, and it
showed it, right? It demonstrated it.
And it's hard to go out there as an individual that's not in that market, that doesn't have the same context, connections, or even numbers in front of them, and go and make an actual decision. Is this a good business idea? You can only go by what the idea sounds like, and it did. I mean, to me, it did actually sound like a good idea,
well, Intel should have been back to double-digit growth at this moment in time, right? That was what Gelsinger was saying. Also, you see this a lot with the companies we analyze. So when you first time start analyzing a company, you look through the numbers, and the numbers say, oh, it's a growing company. You see the CEO's strategy, and you think like, well, seems to work, So it's not bad that people think like direct to consumer is going to make it, and such are the analysts. I think that's normal because you see it confirmed. But then later saying it's bad, I feel like, that's also the moment where you need to say, guys, I trusted the CEO. I was wrong. I
Yeah.
didn't got a good feeling for what the risks were with direct to consumer by killing out the middleman, which still has all the stores and all the big locations.
Yeah.
Yeah, and now in a post-COVID world, people like the shopping experience again. Yeah, it has changed the shopping experience, but my kids, they don't want to buy Nikes online. They want to go to the shop. For them, it is something special to go to the Nike shop and have all this stuff in their hands. Yeah.
Yeah. Yeah. I mean, I think it's easy to look backwards and look at numbers and look at what they've done. It's a lot harder to look forwards, especially when a new
Yeah.
strategy comes in.
Exactly. So I think they have now announced the appointment of Elliot Hill. I thought he retired a few years ago, so he's coming back. I don't believe he was a CEO before.
Former senior executive is what I have.
Yeah. Yeah. So I think he was leading one of the businesses. And yeah, time will tell. Time will tell. I see in Nike, I see a similar pattern as to Starbucks, where the current day CEOs are struggling with really having a good grasp on the uniqueness of the company, like the in-store community experience the Starbucks talks about. But with Nike, it was always, I mean, you want to have the football shoes that Messi is wearing, or Ronaldo, or your local hero in your local league. Yeah, if you follow the Irish league or the Polish or Dutch league, you want to wear those boots.
Yeah.
Yeah, and that's where all the focus should be.
Michael Jordan and so on.
Yeah.
Look, you're quite right. It does look a little bit like Starbucks in a way. They're going back to an old say
a proven strategy that helped them over the last 20, 30 years.
Yeah, that has been there 32 years. But the same problems will exist as what existed with Starbucks.
Yeah.
They need succession planning. They need someone to go in there after Elliot Hill that is able to pick up on that. And Starbucks struggled for a couple of years.
Yeah. And I'm more with the Chipotle CEO. At least he made a good impression already in the first week. But let's see. The years will tell.
Yeah. Interesting one. Look, I won't be rushing to buy Nike based on the new CEO. I think shares increased 9%.
Yeah.
I still think we need to see what he does, but not only that, who comes in after him, I think is more important.
Yeah, definitely. But I'm happy that I bought Nike on the dip.
Yeah. Dividend hikes. We've got some of our American friends. I didn't get a chance to look at any European companies, so if you have any, please shout at me. But Procter Gamble hiked its dividend for 68 consecutive years. Compare that with Unilever. This is quite astonishing, and they have a 7% dividend hike this year. WP Carey has another small dividend hike. This is 0.6%. It's also the third hike of the year, which increased it to 1.7%, but still slow growing after a dividend cut. So nothing to get excited about, I would say. Texas Instruments, their lowest hike that I can remember last year was 4.8, I think. So they hiked their dividend by 4.6%, which makes 21 consecutive years. What do you make of that? Are you happy?
Yeah, I'm really happy. We know that they are, going through a cycle. Let's say it like that.
Exactly. Yeah. Not surprising, I have to say. Johnson & Johnson, another 62 years of growth with 4.2% this time. And T-Mobile initiated their dividend last year. They had their first dividend hike, and it was a whopping 35%. They now pay 88 cents per share.
Yeah, which is really nice. I mean, T-Mobile US, I always liked it with the former CEO. He really built this company. John Levere, I think. So
Yes.
good one. But you missed actually the elephant of the stock market.
What?
The whale. Microsoft.
Oh, Microsoft.
They hiked the dividend from 75 cents to 83 cents, another 10%. I have now a yield on cost of 6.6% on Microsoft.
6.6%. We have a question on that later on about a low yield, but 6.6 on Microsoft is incredible. What are they yielding at now? Probably sub 1. So 6.6.
Let me check. Yeah, well, something like that. 0.7% current yield. No, a little bit more. 0.77, something like that. I didn't update my sheet yet.
Yeah. Nice one. 6.6% is pretty good for Microsoft. Getting close to that 10%.
Yeah. Give it a few years, and then we'll have a 10% in Microsoft, which is actually quite astonishing. Then.
Awesome. So we move on to our main topic, and it is around sectors that do well in when interest rates are cut. And I think this was a question from a listener, which inspired the show. I don't know if it was this week or last week. We got a question around what stocks or companies do you think will do well, or will it have a positive effect on companies if interest rates are cut? I think it was Joe's broke down that brought that up. So I think it's an interesting concept. But what do you think? Sectors benefiting from interest rates? Like why are interest rates cut first? Like is it good? Is it bad? What's the deal?
So most of the times, and I think that's important to know, usually central banks cut interest to stimulate the economy. And what their target typically is to have a 2% inflation annually. But that's when they are moderating it in the normal times. What we have seen most of the times are sharp interest cuts because the economy has been entering a crisis and they start to really quickly act upon that. So here we are not talking about, I think, very hard interest cuts like we saw in 2020 or 28, 29. 28, 29. So I feel that this is more the moderated path, but I think they're just getting some signals that the economy is weakening, and we see that as well in Europe, right? For me, this is so visible, and they probably see it in the data as well. So, and this is probably the reason why they are cutting the interest rate. But the good thing at the moment is it's not like a 2% at once or 3% at once, because the whole stock market is collapsing. So I think this is still under the category of managing. But still, it's usually in response to stimulate the economy. Yeah, it's often seen as a lagging indicator of a weaker economy. So, but it always comes also with this other warning, right? Zero interest rates, then you get those zombie companies, that can take on lots of debt at no cost. And I don't think that's also good for the economy over time.
Yeah, and it's interesting because these questions all come about because of the Fed, isn't it? Because Graham Powell is in the news, seems to be every other week at this stage. But not all interest rates are the same across economies. For example, United States and United Kingdom sit around 5% at the moment. This is before the cut, or September 24, so before this cut. Europe is trading has around 3.65, and China is 3.35. And it's interesting you spoke about weaker economies. Japan is nearly at 0.25.
Oh.
And we can see that their economy is is struggling at the moment as well. So I just thought it was interesting to note that different areas have different interest rates, and yes, it's been cut in the United States, but it's not being cut to a level of Switzerland or Japan, or it's probably not even going to reach the euro area. It'll still be above our interest rates. So as you said, it's a clear sign that they're managing it rather than being forced because of other issues. So I think the first sector I think everybody really knows about, because we spoke about it quite a bit, and it's the real estate sector. That has been quite volatile with Graham Powell. He just comes in and mentions rate cuts or rate increases, and you can see the likes of Realty Income. Its price has been quite volatile over that time. But why is that? Why is real estate so volatile to us?
Well, generally, they often rely on debt to really finance their acquisitions. Yeah, so debt or share issuing, and lower interest rates just reduce the borrowing costs, right? And therefore, the funds from operations will increase. It's really simple from that point of view. So if the biggest cost of a real estate company is servicing debt, and the debt goes lower, and what you need to think about, let's say the company pays 5% in debt and it goes to 4%. This is not 1% reduction of cost. This is 20% reduction of cost. So these are large numbers, right? And I think this is very important for people to take into consideration. That's why also I think realty income should benefit more from it, if you apply the theoretical model, than Agree Realty, because Agree Realty doesn't really need to pay debt, I think, still this year and next year. So they do pay some interest rates, of course, but they don't need to service the debt on top of that. So they are in a much stronger position. So, and that's why also I think Realty Income was also more struggling as of late than Agree Realty. So yeah, typically real estate, and specifically those zombie companies with debt till the head. So maybe actually a company like Omega Healthcare might benefit maybe a little bit from this also in my portfolio. But maybe also some German ones like Vonovia. They are also full with debt. So with real estate companies, it's really the debt on the balance sheet that benefits from this.
Yeah. Like you speak of Realty Income, and they are more commercial based. And I'm glad you mentioned Vonovia, because an additional benefit of lower interest rates is that it's lower mortgage rates, which means people will be more comfortable or will go looking to maybe buy houses more. So it'll stimulate that market. So that would be a big benefit for companies like Vonovia, whose main portfolio is around the residential area. So yeah, I think interest rates is really important for real estate, particularly the ones with large amounts of debt. And we know they have to use debt and share reissuance to fund their acquisitions, because it costs quite a lot of money. So you could see that they were struggling, especially apartment real estate investment trusts. But I'm expecting with the good news of interest rates being cut, I'm expecting them to do quite well. And I've seen that in my portfolio already. Agree Realty went from position 6 up to 2, all because it jumped about $10 or something in my portfolio. So I'm already benefiting.
That's nice.
It is, but I wasn't, like, I was still adding them aggressively, so I wasn't finished buying them. And I think they are above fair value at the moment, which is quite annoying. But I'm still happy with the shares that I've got.
Nice.
So real estate. Next one, utilities. We look at utilities, capital intensive. Again, they have to use large amount of debt to finance their operations or their infrastructure. Infrastructure constantly needs to be upgraded, maintained. And Iberdrola, for example, National Grid are 2 really good examples of this. What's your take on utilities?
Yeah, they just need a lot of capex. Yeah, well, we're talking about real estate agencies, mostly about buying property. That's another part of the cash flow statement. Well, it could be part of the same part of the cash flow statement, actually. But they just need to, for instance, if you're a utility and take Iberdrola and you want to build windmills, it requires a lot of cash up front. Yeah, the cash inflow is very stable based on the energy prices. It could, of course, be more volatile, but it's kind of a given, because specifically for such kind of energy, there is a constant flow of the demand with current economic policies. But it needs huge investments, which of course all go to Siemens. No, not all, but a lot of that goes to Siemens. And I can see it here, right? Iberdrola is now trading already at €13.56. Well, in August or the beginning of August, it was trading at €12. For such a stock, that is a lot of growth suddenly in the last month, and it is also because in the last month the speculation started about the interest rates. So where it was trading in a band of let's say 9.5 and €12 since 2020, since COVID, it really broke out now to €13.5, and I really think it has to do with the lower interest rates here, and better terms for when it comes to financing again.
Yeah, and one company we failed to mention actually is Enagás. We're seeing that right now with Enagás. They are investing in this hydrogen network that they need to expand, and obviously that costs a ton of money, which resulted in them breaking their promise to me, because I was a shareholder that believed them, but they've cut the dividend to actually on that. But I'd imagine these interest rates coming down is good news for them, because it's reducing their expected cost. They would have made their predictions at the current interest rate, I would imagine, when they released it, so it might benefit them. But it's definitely something to look at, especially with utilities that are expanding. When they're finished that expansion stage and they're just in maintaining, it's not as bad. They still need to obviously fund
Yeah.
some capex, but it's the expansion that is the real killer here.
Yeah, and then maybe because now we had two industry that benefits from either debt, lower interest rates, or consumers that can afford a mortgage better again. The third one is actually maybe a little bit more out of the pattern here, is consumer discretionary. Because actually really simple, lower interest rates typically increase the disposable income. So if you need to pay less for your car loan, if you need to pay less on your mortgage for your house or any other personal loan, you keep more money in your wallet. Now, most people are not putting this on an investment account at that moment in time.
Yeah.
Most people in society use this to spend on stuff. So that's where they always say it stimulates the economy. So if you think about this one, travel, retail, I said McDonald's, here, Disney,
Yes.
people able to afford these too expensive tickets a bit more again.
Yeah.
Those are typically companies in this industry that fare a bit better. But it comes a little bit with a delay maybe compared to others, because it still need to trickle down into the wallets. Yeah, because for instance, some people have fixed mortgage rates. Yeah, so it usually takes a little bit slower before it trickles down.
Yeah, but it also increases the likelihood that the middle class will go and take out a loan to go on that holiday, to buy that car, like the likes of BMW. They'll benefit from this because lower interest rates, they'll be paying less. And if they were paying 9% or told they were paying 9% last year, now it's 4%. In their mind, it's a good deal. So they're more likely to take out that loan. So
we're still talking here about 0.5% interest rate cut, but it's still, how I said, it's the trend that's now being turned.
Yeah. And what about financials? I'm assuming we leave banks out of this because they don't like interest rates going down. But
no, and they don't like interest going down because that means they get less spread on what they charge on the savings rate. I mean, I would argue that in the Netherlands, it's probably more like a scam, where they keep the interest rates very low. It just shows lack of competition, and the banks have been earning really a lot of this, over the back of the consumer, and they will have less spread. It's as simple like that. But you need to think about companies that in this sector benefit from it are typically insurance companies, asset managers, and these market lenders again, because, for instance, often people want to do more mortgage refinancing. I said there's more demand for certain financial products. Maybe life insurance becomes more interesting again. People want to maybe invest, so they want to have an investment advisor that helps them. So these are typically reasons why this helps. But also on the insurance companies itself, they have a lot of real estate on the balance sheet, serviced by debt as well. Yeah. So also this might help that the asset value of the real estate goes up in return, and therefore make the value of the company more attractive.
Yeah. I get your point with banks. Obviously, their margins will be under pressure a little bit more, but I could imagine with these small decreases like 0.5 and 1%, it might actually spur people, as I said, mentioned earlier, to take out loans. So they might have that initial outweighing. So if it's over a sustained period of time, they won't like it. But initially, if they get more customers out of this, it might outweigh.
Yeah, so that's a question of volume. Yeah.
And then obviously, I think the common trend here is what we're seeing is companies that rely on debt or they rely on capital to finance and grow and expand and operate their businesses. And one industry that comes to mind is industrials. And industrials, we know, are quite cyclical. They have to expand constantly, like every 5 or 6 years, especially the way technology is going. It's constantly evolving, constantly changing. I'm seeing that in my own place. Product lines that were lasting 10, 15 years, we're now getting 6, 7 years, which means we have to constantly reinvest into the business and it requires a lot of money to do that. And one company that stuck out to me when thinking about this was Caterpillar.
Yeah.
Caterpillar are highly capital intensive. I was looking at their debt to equity was something like 2.2 at the moment. They rely on a lot of capex to purchase equipment, to build facilities, to expand their product lines, and I think industries is one. But it was quite interesting. You mentioned Siemens earlier. It looks like that they would be a beneficiary of all these industries nearly, because they make the parts for all of them.
Yeah, exactly. So that's maybe also one of the reasons why I'm so bullish on Siemens in generally. But I must confess that the stock went 2% down yesterday. Not sure if that is related to the interest rates. But no, for me, it's clear that a company like Siemens, such an European industrial, should generally benefit from this. But also BASF, maybe they are more in the material sector. But this is also such a company that needs large investments. Depends a lot also on the gas prices, of course. So it's maybe not so strong as what you mentioned with Caterpillar. But yeah, these are indeed some companies that really may benefit just from lower debt servicing. And I would also, I would recommend everyone to look at some of your holdings. Just look at the interest payment that you see on the income statement. They usually in the annual report also say what the average interest rate was that they were paying. And then think about if it would be 0.5% lower on the total amount of debt. Calculate what it means in interest rate, and then go back to the income statement, take this new number of interest deducted from the current income that was generated, operating income, and see the delta. This may easily, in some cases, be a 10% difference on net income, depending on the margin, operating net profit margin that they have.
Yeah,
and then it becomes big numbers. But there's also one other thing that I think applies to each and every company that people should also remember. Lower interest rates decreases the cost of capital generally. The cost of capital is one of the most important metrics people, or let's say factors people analysts use when they're evaluating a company. Because if you think about a discounted cash flow calculation, what you and I do, we don't take necessarily the cost of capital. What you and I do is say we want, let's say, a 10 or a 12.5% discount rate, because that's our return that we want. But what many analysts do, they look at the cost of capital at a company, and then, for instance, if the cost of capital at a company is 8%, which is a mix of debt and shareholder expectations in return, let's say it's 8%, and it goes to 7%, that really boosts your fair value price. This is also one of the reasons why our fair value prices are typically much more stable, because an analyst just follows the interest rate pattern, because they are not giving often advice for the next 20 years. They're often giving advice for the next 2-3 months, as long as the interest rate is the same. And that's why you see those fair value prices much quicker changing. And there's a lot of volatility with that because of this component of the cost of capital, and it can really make a big difference in their fair value price and what they recommend their customers.
Yeah, good point. So it's quite important also for companies, but for us as investors to keep an eye on it, particularly if you use it in your valuation.
Yeah, exactly. So, hey, these were 5 sectors that we think typically benefit from lower interest rates more than maybe the others. You will also find, of course, benefits in the others. Like I just mentioned, there's an overall benefit. And I think the task to us is that if we think that these interest rates will be lower for longer, and if we think that we're not running into a huge crash right now, I would definitely argue that it probably is worth still looking for some stocks that may still have a lot of upside potential in these industries.
Nice one. So we move on to some of the listeners' questions now. And we got an interesting question. I won't mention the name because there's some information in there, but to make a long story short, I would say this person is expecting I would say, quite large inheritance. So 2 apartments, a house, and a sum of cash, which is not insignificant, I would say. And the question is that what would we do in this scenario? So I don't think he's planning on keeping the apartments because he doesn't want real estate on all that hassle. He might keep the house and the cash. So what would you do with that if you were to have that kind of a windfall come up?
Yeah, because first of all, what we say is not investment advice. It's this person's money, and he's accountable for managing his own money. I think this is really, really important to mention. But how I see it is he's looking like for some different opinions to get his thinking clear. And I also recommend anyone that's listening to just post on Facebook what you would do with it, because it's a very interesting question, and it's a very tough decision to make, because these may be numbers that you have never seen before, and you will only experience this once in your life. Yeah, and that I can imagine it would make me a bit more nervous. Yeah, if I would have 2 apartments in this thing, and whether I should buy or sell them, it really depends for me on how much these apartments are cash flowing and how far they are from where I live. I would be okay if those apartments are rentals within a 1 hour radius of where I live, so that I can go there, that I can do some business myself. But I also understand that it's tricky to not have the hassle. Why I would still consider the hassle in such case if they are really nicely cash flowing. So cash flowing is for me like more than 10%. Yeah. If these apartments are in a neighborhood where you can still expect capital appreciation on your asset, but also just because it would diversify my net worth. I'm effectively mostly in stocks. I do have some real estate, but it's not cash flowing, let's say. And I would actually take the pain on my shoulder that maybe if the toilet breaks, that you need to do something there. But I think here you can then do it yourself or not. Maybe this person can retire on this alone already. So it would be your day job to once in a quarter fix something that may need to be fixed. Or you find an agency that can do this for you, that can just manage everything. You hand in a little bit of the cash flow yield that you get out of this apartment, and you sleep better at night. If you really, really don't want this, but in my case, let's answer it from my side. I would take those 2 apartments probably if it's in a 1 hour radius. If it's further, I would probably sell them, hopefully in the most tax advantageous way. And yeah, then it's not my goal to have all my net worth only in dividend stocks. Yeah, so I would still think about, is there anything, maybe an apartment neighborhood that would be cash flowing well, but otherwise, yeah, I would probably still put it in my dividend growth portfolio, because that's what I am familiar with. That's where my circle of competence is. And I would probably put it in some real estate investment trust, not too many, but I mean, these are large sums of money. Yeah, very large. 2 apartments, then I don't know which locations, but we are probably talking about hundreds of thousands.
Yeah.
Yeah.
Yeah. It's, I mean, from my perspective, I don't know the location. I don't know the location of this guy. Okay. So it would depend on location to location, because everyone's in Europe, we know this, the real estate market is quite diverse and there's different rules. I can tell you in Ireland, 10 years ago, my answer would be different than what it is right now. But the first thing I would do was I go and speak to a tax advisor first.
Yes.
If I was planning on selling the apartments, so first of all, in Ireland, we get inheritance tax. So you can earn it, you can be gifted or inherit a certain amount of money. Then after that, you would pay tax. With the amount of cash, a house and 2 apartments, I would be over that threshold. So I would be paying tax anyway. So I'd need to speak to a tax advisor to see how I'd handle that. The second part of that is, if I'm selling the apartments, I would then be eligible for capital gains tax. So it's like a double taxation.
Yeah.
But I don't know if I'd want that. So I would definitely speak to a tax advisor based on location, see what is the most tax efficient way to extract the most amount of money out of that. Now, going back to what I would do, assuming that tax wasn't wasn't an issue. In Ireland, the laws around tenancies are changing, so it's becoming harder and harder and harder to be a residential landlord. So if you're not a company, it's 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 coming harder. They're bringing in these, well, there's talks of bringing in these laws like infinite tenants, that you can't kick the tenant out, that if you want to sell the house when a tenant is in it, you can't do it. If you want to live in a house that a tenant is there, you can't kick him out, and all these sorts of complications. So the laws will be different here, so I would probably end up wanting to sell both the houses and the apartment. And what would I do with that money? I mean,
Would you lump sum or DCA?
I would probably DCA in, if I'm honest.
Yeah.
I don't
You
know.
technically speaking, statistically speaking, lump sum is advisory.
Yes,
From a return point of view.
I get that, but I'm thinking of my habits and behaviors as a retail investor right now, where I'm used to investing. Probably, I'd say the most that I've put in at one moment would be 5,000 in a single transaction. Now we're talking about
20,000, 30,000.
You're talking about more than that.
50,000.
If you're talking about in one go here, 2 apartments in a house, you're looking at maybe, let's say, 500
plus the cash. Plus the cash.
That's close to $1 million nearly. Say,
yeah.
I don't think I'd have enough conviction to put that in on maybe 5, 6, 7 companies at one time. It would be a hard thing to manage psychologically for me.
Which is interesting, because your psychology also changed with the size of your portfolio. You're investing now more than you were doing 3 years ago.
Exactly. Well, that has a lot of factors. My income has increased.
True, but you get used to the volumes as well. Yeah. If I see now, let's say sometimes my portfolio is going down, I think like, whoa, that's what I make in a month.
Yeah. And I would agree with that 100%. You would get used to it over time, but going from my position now to investing nearly $1 million or $500,000. It's a big jump. It's a big jump.
Yeah, I would also DCA. I would probably spread it out over 2 years or something like that, just for my comfort. And that's what I will probably do over 2 years. I would also then, for instance, take half of the money, lots of the money, let's say half of the money, and put it in such a savings rate deposit for a year, maybe at what you can now get in Poland, maybe 4 to 5%. Because in 2 years I would be spending that, so I would still try to grab that yield on my bank account in the meanwhile. But I will also DCA, because I think I would be too nervous to push everything in the stock market, and I also don't think that I have the intelligence to put, let's say, $1 million at once in those 5, 6 stocks that I think here. So I would probably spread it out, and that helps you also with some second thoughts that you might have. And such, just to mitigate the risk of mistake. And I think that's what I always learn from Buffett. If you don't know everything about it, because he says like you just need 3 or 4 stocks. In the end, he has also a lot of stocks, but Apple grew into his biggest and is doing all the heavy lifting, right? But there is something to it. We don't have the insights that Buffett has. He just picks up the number, calls the CEO. We can't do that. So
and I think one thing we failed to mention, and what I would definitely do, is I would not be looking to invest or save all of this. I would enjoy a portion of it.
Yes. I mean, you only die once. So make this dream trip that you ever wanted. Now is your time. Go travel the world for a year. Take off from work if you can afford it. I mean, I think that's probably the best thing that you can give in the memorial to the parents.
Yeah. So we keep our name private. We try to keep as much detail as possible private, but we hope our ideas are beneficial in helping you make up your own mind.
And I would hope that people continue the conversation with this on Facebook. So the question is, when you're on Facebook and you're listening, what would you do with $1 million if you get it inherited in the form of 2 apartments and money? Let's assume it's $1 million. What would you do?
Okay, Manny Mystery. How do you measure the strength of a CEO of a business? Do you have any metrics that you look at as that indicates their strength and their success?
Yes, but honestly, the share price of the former company that they were managing. So I've been thinking about this question the whole morning. What I've seen in patterns is that CEOs coming from a former company where they doubled the share price in 4 or 5 years or something like that, supported by strong revenues, is very important for me. And it should be in a similar line of business
Yes.
where you can really see it's a competent CEO. Now, we do have sometimes homegrown CEOs, those that come out of succession planning from internally. Those are a bit harder to judge. And here I do prefer people coming out of a COO role versus a CFO role. Usually when a financial officer becomes a CEO, that's a red flag for me. And I've seen this as Shell before Ben van the Berde came, was a CFO. Yeah. I've seen this a lot. So I would prefer COO or something like that, someone that really came out of the core business process and not a CFO.
Yeah, it's a tough question. It's a lot easier to compare them if they're moving into a similar industry because you can compare apples with apples. But we look at Pat, for example, Gelsinger. He came from VMware, which is a slightly different industry than Intel, and he was very successful at VMware and struggling at Intel.
Yeah, but who was Bob Swan before?
What?
Wasn't he a CFO at Intel?
Oh yes, he was. We had a whole had a whole show.
He positioned the company where it is today. Yeah, so let's still give a bit of. I know Pat Gelsinger has been not living up to his promises, but I think he has underestimated how far the competition got behind due to the CFO Bob Swan before.
Yeah, they're so far behind, and there was talks of them being. Did you hear that? Talks of them
being acquired. And I think we have a question about that as well. And it's a question from Philip Zimic. He's asking about Qualcomm takeover offer for Intel. What's our take on that?
Is it a cheeky bid from Qualcomm? But I mean, it might make sense. Intel are I don't know what they're trading at now, but they were trading cheap. Well, cheap in terms of valuation at some point, so it could make sense.
Yeah. I think the issue is with Qualcomm is firing on all cylinders. So if they find Intel interesting to acquire, it means that they see a lot of potential in it. Now, seemingly then there is a lot of potential in it. Yeah, so then I prefer Intel to stay private, so to stay on their own. But the question is then, after now, when do we start to evaluate Pat Gelsinger's performance? Yeah, we always knew this needs 2-3 years. We always knew the turnaround, the ASML machines. When do we give up on him? That's for me the biggest question.
Yeah, but there's talks of buildings in Europe not going ahead, and there's a lot of false dawns, a lot of false promises.
Yeah,
the CHIP Act was meant to be the savior of Intel. And I don't know. I think the time to judge him is now. Honestly, I don't think he's lived up to the hype. And there is potential in Intel. I think we all see this, and we all want them to do well. We've all had some affinity with them, even considering how bad they've been. We had a whole investor. We used to meet up every investor day for them. But I think someone like Qualcomm coming over might be able to stabilize, might be able to give them the cash they need, and help the company, and maybe spin them off again later on. But it might be.
It's very interesting. I mean, I wish. I mean, I don't. I think it's good that people are religious like that, right? But I think, like, please, every Sunday is preaching to the Lord with all his verses and
go to mass.
But if that's where you need to get your faith from in turning around the company, oh boy,
we're in trouble. Tim has asked us, if you guys haven't found dividend investing, what would you be doing instead?
Probably put it on my savings account. That was my mindset before.
I would have definitely looked get into property at the time. Property is always quite big over here in Ireland.
Yeah, I would probably also have bought an apartment somewhere here. That's probably something. Yeah, that's a typical thing I think people do here. But what would you do with your time? Not having a podcast and such.
I don't know. What I'd do. I might still be playing football. I've tried it. I'm now injured again.
I may be many kilos fatter or something like that, but just hanging on the couch and watching telly.
Yeah, Diageo share price might be double because I'd probably be drinking one.
Exactly. I think this has only health benefits.
Joe's broke down, as we said, inspired the team for the podcast. And he was asking, what do you expect from the developments in dividend stocks in the near future after recent income and rate cuts?
Well, it's really simple, right? And if debt servicing gets lower, I think we will see higher dividend hikes. I think it's really as simple as that, because some CEOs, they will use that as an opportunity to reward shareholders more. Maybe also buybacks become more aggressive again.
Kieran Ainsley, energy stocks on discount was PPC Ian's latest video. He mentioned Shell and BP cut their dividends in the pandemic, but Chevron held strong. Do you consider this in your Shell conviction?
Yes. I own, by the way, full disclosure, also Chevron. I always felt that Chevron was best managed, or having the strongest portfolio, oil and gas portfolio. But Shell went really down. Yeah, I mean, Chevron as well, but Shell really took a big beating. And Shell was managed by a CFO before, which Ben van Beurden at the time had to take over. And we spoke about that at length many times. We all saw this coming from Shell. It was the best thing to do. It was really hard for them to sustain a dividend, and they held it. So then it's kind of the sunk cost fallacy. What do you do after that? Yeah, and we had strong conviction there because it was a combination of value and dividend growth potential. Yeah, with Chevron, actually, Chevron just demonstrated its quality, so it didn't give the same opportunity as Shell. Let's not forget that Shell didn't cut the dividend almost since the Second World War. They had to reset it. Yeah, and now in hindsight, it's easy to say, but I had really strong conviction at the time with Chevron as well, but not the same value was presented to me.
Yeah, it was presented, but very briefly. I think it rebounded within a week, even less than a week. Looking at the chart, whereas Shell, it was prolonged, and you could make a rational decision and have time on that. So I think that is the difference. But Ian Lopuk is a clever guy. Watch his video; it is actually very good as well. I've watched it. So thanks, Kieran. Levin van Dividend, your Dutch comrade, he said he's read your great yield on cost with Microsoft. I wonder if you would buy the company if you had no or a very small position at a dividend yield under 1% like today.
No, I wouldn't. It's a very simple answer. Too little dividend.
I agree. What do you think about Estee Lauder?
Inferior to companies like L'Oreal and LVMH. I mean, like, why own Estee Lauder? I know it's a value play.
Yeah,
and it may sound a little bit contradictory to the conversation just about Chevron, but I have a feeling that Estee Lauder is a bit more broken. Yeah, and that's why I say L'Oreal or LVMH.
Everyday normal investor, he said Nestle is below COVID lows. Would you buy or not?
Well, it is the #1 dividend aristocrat in Europe. There's just nothing that really attracts me in this company. So it's personal, probably. It's not maybe rational. There's just nothing that attracts me there. And that's it. I don't like their balance sheet trend. I don't really see proper growth. No, I'm having probably a nationality bias by preferring Unilever over Nestle. While Nestle has held up better over time, or done better.
Yeah, Nestle seem to have decade-long currency headwinds that impact the whole business, which results in them having to to take out debt to fund some of their activities. So I struggle with Nestle. I see the growth too slow. I don't see the attractiveness there. I think there's definitely better options there, which is a shame because, as you said, it's the #1 dividend company on the Noble 30 list. So you kind of feel obliged for it. You want it to do really well.
Yeah.
But I struggle with Nestle. I really do. Mac has asked us about General Parts Company, ticker symbol GPC. Have you ever looked into this dividend king?
Yes, specifically in my early years of dividend growth investing, because every time you open up the dividend king list, you see a Genuine Parts Company there. Yeah, but it's not my circle of competence really, because this one always comes up in the filter. I don't know what's yielding today, but it was always yielding above 3%. I felt it was always a bit too volatile for my liking, as well. But they have stood the test of time. I just don't understand the company well enough. I tried it, but yeah, no.
Yeah. American, if I remember, they're American automotive parts and replacement of parts. And
Yeah. So, and then I think like, oh, in an economic downturn, no cars are being sold, but maybe more secondhand is being sold more, and that's why more parts. Maybe that's what builds their resilience. But I just don't understand it. And when you can't get a feeling for it, it's really hard to invest in something. So sometimes they're just really great companies that just check all the boxes of the metrics, and everyone may be buying around me these stocks, but if I don't have a feeling for it, I can't build conviction. I don't want it in my portfolio. That's one of those things that I learned.
yeah. And it's one of those examples I mentioned earlier. It's easy to look backwards and say, yeah, the company was great. It's doing great.
Yeah.
But it's the sense you get looking forward. And then we have this transition to electrical cars, and how does that benefit them? And
Yeah.
I know they do industrial replacement parts, but that changes with technology in different parts. So
Yeah.
I struggle looking forward with this type of company. And then last question is from RMS, and he said they have said that they have looked at Munch on Machine, man and machine for us in that speak English. He's looked at them again and must say that it's a great company with a good combination of yield and growth. The downside is the high payout ratio. Are you holding it or planning to add to it? I spoke about them 2 episodes ago. We got some heat on Twitter about that episode, but I really like this company. As I said, the reliance on Autodesk is reducing. Their crown jewel is their software department with really high margins. So I am currently adding in small bits at a time. I think they're around fair value. They're not overly undervalued or anything like that, so it's not worth adding them in droves. But I'm just tipping away and building a position.
So I don't have a position yet, but I like the company. Maybe I need to give it another chance to look into it. I mean, you wrote a really good article about it, so I really enjoyed reading it.
Yep. Nice one. So that concludes the podcast today. Don't forget, guys, to comment on Twitter, on Facebook. Let's keep the conversation going around what you would do if you inherited a large amount of money, because I think it's really interesting, and it'd be fun to actually hear everyone from different geographic regions and how we would handle that. And until then, we'll see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just 2 guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.